when trying to do average. Okay, so here is what we have. Okay, so we started from here. We've looked at the two type of profit we have. We have accounting profit. We also have the um the paid taxable profit. I mean to say, I also showed us all these plays yesterday. The accounting profit and then the tax man will take your accounting profit and use it to back to get the all this. We also said that to get the current tax, you need to say profit by tax. We look at that yesterday as well. Then we went further at deferred taxes. So that they are deferred taxes, they are uh, taxes, they are the differences that occur. They are temporary differences that occur when your carrying amount exceed your recoverable amount, or when your recoverable amount exceeds, did I say recoverable amount? Sorry, tax rate. It's tax rate. So there are differences that occur where the tax that occur. So the differences that occur between the and the carrying amount, are we together? Get it? I need conversion with your screen, and then you get.
Yes, sir. Yes, sir.
All right. So look at that. Let's now go straight to what we need to do. So we've looked at that. We needed to look at what different taxes are. We know that when you get a difference between your carrying amount and also your tax base, that difference is multiplied by the tax rate. When you multiply by the tax, you will get what we call the deferred tax. So there are two different taxes that we have. We have deferred tax liability. We have a deferred tax asset. So now when there is a difference between your carrying amount and your tax rate, give rise to what we call temporary difference. And those kind of temporary difference either the taxable temporary difference or deductible temporary difference. When you say something taxable, it means that it's going to create liability for in the future. So something is deductible, it's going to create an asset for us in the future. We've been able to look at all these things. There's a question here that we also went further to look at that illustration 2, where I told you categorically that when you have normally we compare the kind amount with the tax base. However, we now discover that when there is a value amount, right, you should forget the carrying amount and just take the value amount and compare it with tax said. For that to look at also took the element of the financial statement. I told you that financial I told you the asset, expenses, the income, the liability, and the equity. So all these five elements, they have balance that they must have. The first one that you have so-called debit balance, that is for assets. Expenses also have debit balances. Then we went further to look at income, liabilities, and equity. So all these three, they have credit balance. So we are getting it. Are we together? Give me a thumbs up if you can hear me. I want to be sure that we are together.
We are together, sir. We are together.
All right. So thank you. So we now went further yesterday to look at tax expense to recognize in the same position. I told you that this means that you have to recognize in the of financial position is the current tax to be there plus movement in deferred taxes, right? So you know how to get your current tax. You say your profit that you multiply by the tax rate is going to give you your tax. Then you also need to look at the movement. And for instance, you need to learn to calculate deferred taxes. I told you that to calculate deferred taxes, you need to compare your carrying amount of your assets and your savings. So once you have done, then friends that you get between the carrying amount and your tax base by the tax rate that we have in the. So when you check your taxes and the current amount, that difference between it is going to be what we call a temporary difference. So that temporary difference can either be a taxable temporary difference or a deductible temporary. When a temporary difference is taxed, it means that your carrying amount is higher than your tax base. What temporary difference is deductible. It means your carrying amount is less than your tax bill. Okay, so I think you know that. Then we now went for that. Okay, have we calculated our different taxes for last year, which I took back to. Okay, as we calculated the different taxes for last year. Let's look at how to calculate our different taxes again. In a question, it will give you this. You see the list of assets. So I also told us that there are two ways we can calculate deferred taxes, or deferred taxes. The uh, loss loss method. You can also use the balance sheet method. Okay, so when you are talking about balance sheet method, actually about asset itself, where you are comparing the current amount of asset and the tax base. But when you're talking about the profit and loss approach, is where we go by saying this is the profit, right? You add your decision, add your decision, then let's look at the allowance. Then you're going to have your taxable profit. So using the profit and loss method, this one is good. But when you're using the profit method, you asset themselves. You're comparing carrying amount of the asset, you're comparing it to base asset. Now, here we are trying to do our liability, right? Our deferred tax. We are trying to determine our deferred tax. Let's not forget deferred taxes are always liability. That deferred taxes are going to be assets. So how do we know whether it's or is a liability? List out all the assets, right? Listed out all the assets, start with the carrying amount of what the assets. So it's the kind amount of what the asset is them. Then the next thing is list out all the tax assets. How do you do your carrying by taking the cost of the assets, minus accumulated depreciation, accumulated carrying amount of the asset. Okay, so it's up, Madam. Madam Rebecca, you want this up?
Yes, please, sir. Good afternoon, sir. Sorry, please. I don't know if it's from your network. It's breaking. It's not clear. It's kind of fluctuating.
Yeah, the
Okay,
same issue is over here as well. I thought it was me. I had to rejoin, but it's still the same thing.
okay. So I will do something. So is it the same now? Like check it now. Is it the same? Is it better now? Okay, so I believe it's better now. So what happened is that I had to make the network to concentrate on only the call. Okay, so thank you for calling my attention to that. And that's a good one. So we continue now. Now, I told us that there are two methods that we can actually use when trying to get our deferred taxes. We can either use the balance sheet method, we can use the profit and loss method as well. So when you are using the balance sheet method, right, we are dealing with assets. So under the balance sheet, you have assets, liabilities, and capital. So when you are starting by comparing the carrying amount of an asset to the tax base of that asset, we are using the balance sheet approach. Okay, so the balance sheet approach is where you compare the carrying amount of the asset to the tax base. So what do? I say let the carrying amount be listed first. So you now compare your carrying amount to the tax base, the difference. So when you press your calculator, you say 40 minus 25, you are going to get 15. It's positive. The next one, you say 10 minus 14. You're obviously going to get a negative figure, okay? So negative 4,000. Then the next one, we say 6,000 minus 8,000. You're going to get a negative figure. Then 16 minus 16 is 0. 5 minus 5 is also 0. So when you add everything together, you now check what you have at the bottom. If you have a positive figure, then you have a deferred tax. So you have a taxable temporary difference, which when you multiply it by the tax rate, it will lead to a deferred tax liability. Okay. Whenever this thing you have down here is positive, note that it's going to give rise to a liability. Okay. So deferred tax liability. However, if what you have at the bottom over there is negative, then it will give rise to a deferred tax asset. Are we together? Are we together? All right. So I believe that is well noted. So we now look at what we did last year. Okay. We now multiply this 9,000 by 30. We discovered that we had a deferred tax liability of 2,700. Now, because it's a deferred tax liability, right? When we now, that is what we are, because already this year we are done with the tax we want to pay. So this is what comes to the next year. So we come to this place where we have here. So we now say, okay, since last year we had a deferred tax liability of 2.7, and that is what we have here. Because it's a liability is going to be on the credit side, okay? Liability is going to be on the credit side. Now, the next thing we're going to look at is, we now look at this year now. This year, we have already calculated our tax base. Sorry, we've already calculated our current tax, which is going to be your taxable profits multiplied by the tax rate. It's going to give us our current tax plus movement in deferred taxes. We are trying to get what expense do we normally put, what tax expense do we put in our profit and loss account as the tax payable for the year. Okay, so like the provisions that we normally create. Okay, so we now do this. We now say we've gotten the deferred tax for last year, and it's actually a liability because it's on the credit side. What about this year? What is the deferred tax for this year? Already, you have your accounting profit. The taxman has the taxable profit, right? So we know that you assume that you are going to pay tax on the accounting profit you have, whereas this guy is saying no, you have to pay the tax on the taxable profit. So if you are using the profit and loss approach, you would have started from the accounting profit, right? Then you add back non-cash items, which is depreciation. Then you get your figure. You now less the carrying amount before you now arrive at the taxable profit. But that's not what we're looking at. We are looking at that expense that they will now finally, after the taxman and the whatever, after you have done all those plus and minus, you want to arrive at the tax provisions that are going to keep. Okay. So we now say that you have done your current tax. We're not looking at the movement in deferred tax, right? We've seen the deferred tax for last year. So you now come here, they now say they gave us information for this year. You now also try and calculate deferred tax this year. You now say in the additional information, you are giving the temporary difference to calculate deferred tax. And look at it now. With this information, you have to calculate your temporary difference. Take your asset, compare the carrying amount to the tax base. We saw that we have 8,000 here. We are also comparing 10,000 to 14,000. We are getting a -4. 6,000 to 8,000. We are getting a -2. 16 to 16 is 0. 5 to 5 is 0. When you add everything together, you're having 2,000. So this 2,000 now, is it positive or negative? It's obviously positive. Now, because it's positive, it's going to give us a taxable temporary difference. So this taxable temporary difference, when you multiply by the tax rate, you are going to get a deferred tax liability. So what do? We now come over to our T table, right? Our T table, we come over to, now, if we are to check it from here, we are trying to check the movement from here, okay? You need to now do the way your account is, you put 2024, you put 2025, both of them are liability. So here you have, last year you are having 2,700 is a liability. This year, they are not showing that the liability is no longer 2,700, the liability is now 600. What happened? It means out of this liability, we have settled out of it. So we now say 2,700 minus 2,100. We are going to get 600 because both of them are actually liabilities. So this is it. The movement is a negative 2,100. Okay. So when you take this 2,100, negative 2,100, you now add it to, so you are having your current tax to be how much? 30,600. Okay. So 30,600 plus minus 2,100. So minus, we always take precedence over plus. So it becomes minus 2,100. Okay, so that is that. But however, if you also want to understand it more, you don't want it to be like this, because some people can understand it this way. Why some people, they needed to come and use the T format. So if you are using the T format, realize that last year we have a deferred tax liability because it's on the credit side, it's a liability, right? So you come to your T format, you have debit side, debit credit, just come and put your figure on the credit side, exactly the way it's on your trial balance. Where is that trial balance again? I'm coming. Okay, exactly the way it's on your trial balance, so it's on the credit side. Just come and put it there like that. Then the next thing you want to ask, this year, did we also get a liability or did we get an asset? Who can tell me? Was it an asset we got or was it a liability we got? Who can tell me quickly? And I want to also hope that we are not having a negative, sorry, we are not having, my voice is not breaking, as you said before. I want to believe that. Can you hear me? Nobody's responding.
Yes, sir. It's clear now. It's fine now. Thank you.
Okay. Okay. So that's that. I just needed to hear that from us. So now the next thing we're going to do right now is to proceed. Yeah. And then what do we want to do? We want to, yeah. So let's proceed now. So we've seen that last year we had a liability. This year we also have a liability. So liability is always on the credit side. So if you are taking it to the T format, because it's for this year, therefore carry it down to the, it's supposed to be on the credit side. So therefore carry it down to the opposite side. So we now come over here, we now say, since it's a liability, what do? We ought to post it to the credit side, but carry it down to the debit side first. Carry it down to the opposite side. So we carried it down to the opposite side. Then here we are having 27. Here we are having 600. So what is going to be the difference? The difference is going to be this. Now, when you are trying to balance an account, the IAS side is what we put as the balance at the bottom. So the IAS side is what we put at the balance at the bottom. Then we now check, okay, what is the difference? Here is the same 2007, nothing is coming here. But here, we only have 600. So this 2007 minus this 600, we're going to get what we needed to put here to make, when you add this and this together, it's going to give you 2,700. So therefore, it means this difference is what is going, the balancing figure is what is going to the statement of profit and loss. Okay, that's what goes to the statement of profit and loss. So this is what we are going to put. So sorry, I said, so this is the difference. Sorry, this is the what? This is that movement in deferred taxes. Now, this deferred tax now, we are saying that we have a movement on the debit side, okay? On the credit side, we always have liability. On the debit side, we always have what? Asset. So it means that here we are taking an asset over. So when I take an asset over, which is that 2,100, right? It's an asset. It's on the debit side, it's an asset. Credit side would have been a liability. So when I come over, we're now going to check what is our current tax. Our current tax naturally is a liability, right? Now we're not taking an asset to it. We're not taking an asset to it. It's like taking your negative 30,600 now plus 2,100 to it. You're still going to get this 28,500 because this tax is a liability. You're going to pay tax to the government, right? Is a liability. So current tax is a liability, right? Now the movement in our deferred tax, now we determine whether we are going to have a liability or we're going to have an asset. And when we did this thing, normally our liability ought to be on the credit side. For last year, treat it exactly the way it should be. For this year, it's supposed to be on the credit side, but first of all, carry it to the debit side first to know what the balancing figure will be. The reason why we are carrying it to the opposite side first is because we want to know what the balancing figure is going to be. So we now say we carry it down to the opposite side first. Once we carry it down to the opposite side, we now balance our account by putting the IAS side at the bottom, the IAS side at the bottom. We now check the difference. What is the balancing figure? The balancing figure is now giving us an asset. So since we have a balancing figure as an asset, we now take that balancing figure, we now carry it over because that is the movement in deferred taxes. We now come over, we now say, okay, current tax is actually 30,600. And this current tax is a liability, right? So then we now carry an asset to it. So if you have a liability, we now put an asset to it, they will write each other off naturally. So you are going to have what? 28,500, which is the tax that you're going to put in your profits and loss. The tax expense for the year is going to be 28,500. So let's unmute our mic and let me know that you understand this before we now go further. Let me unmute your mic. Let me be sure that you understand this before we move further. Okay, who is unmuting this our mic? Hello? Are we together? Do you understand? Or is confusing? Do we understand it or is confusing? Nobody is saying anything. Okay, so you are not saying anything. Do I assume that you know it or do I assume that it's technical? Which of them is it?
It's technical kind of, sir. So we'll have to look at it over and over again before we now master it. Thank you. I'm speaking for myself.
Problem.
I don't know for others.
All right, no problem. So that's fine. That is fine. Okay, so what we're going to do now, we are going to continue. Okay, so we are going to continue from where we stopped. All right, so we now hold on, I'm coming. I just want to quickly do something. Okay, I just want to quickly do something. Just give me 2 minutes. Then we're going to consider others. So you discover that it's actually easy if you just follow through my leading. It's very easy if you just follow through what I'm actually saying. Okay, so now this is what we're going to do now. This is what we're going to do. Here we now have another scenario. This scenario 2 is assumed that last year we also got a deferred tax liability. It means that on the trial balance, you're going to have your deferred tax, right? Then the figure will be showing on the credit side to show that it's a liability. Then they now say this year also, we now had another deferred tax liability of 700. So if you are looking at it from that angle, we say, okay, last year we're having a liability of 1,000. This year they are now saying the liability is now 700. It means that part of the liability has been settled. So this 1,000 minus what? Minus 300. That is what will give us 700. So that is what it means. Okay. So it means that the movement is a negative 3. However, if you want to come to this T format also, we now say, okay, since this deferred tax account is having a credit balance of 1,000, right? It's having a credit balance. So this year we now have another, they say we have a liability. So because it's a liability, naturally it's supposed to be posted on the credit side, but we carry down to the other side so that we can get what is the balancing figure. This side is 1,000. So we want to get what is the balancing figure. So we have to carry down to the other side, and then we now get that the balancing figure actually is 300. So here is standing on the debit side. The balancing figure is on the debit side, which means that this balancing figure is actually a what is an asset. So you now come over, you now say, since our current amount, our current tax is actually a liability on its own, then the movement in the deferred tax is now an asset. So what do? You now say, this is a liability, 800. So you have to pay part of it. You are paying part of the liability. That's why we are minusing 300 from it. Okay. So since this is an asset, is on the debit side, we are minusing 300 from this thing so that we can get what the balance liability is going to be. So that is for that. So let's now try something different. Let's assume, okay, look at this one now. Here, for the year, we have, for this year, we have a deferred tax asset. When you see your asset is on the debit side, it's a deferred tax asset. So what do? This is what you do. You now go and, hold on, no. So since you have a deferred tax asset, you will now go to your T format normally, or let's first check. So here we have a deferred tax asset. Here we are also having another deferred tax asset for the year. So they say at the beginning, we have, okay, for the beginning, we had an asset of 1,000, right? Then this year, it has gone to 1,500. So there is an addition of 500. So we have an addition of 500 from last year to this year. So we have an addition of 500. So what do you now do? Because it's an asset, we now come to this place, right? Assets are always going to be on the debit side. We put the 1,000 on the debit side. Now, because the other one also is an asset, this is this 1,500, right? Because it's an asset also, what do we now do? We now carry it over to the other side. Now it's supposed to be on this side, right? Because it's an asset. This here is an asset. It's supposed to be on this side. So we now carry down to the opposite side. So this place now becomes the IAS balance. Here, both of them are now 115. Then what do we now do? We now say, okay, here the place is balanced, but here there's a figure of 500 to make this thing balance. So here we are having a balancing figure of 500. So that's why it is negative. So we now come over, we have an asset. We come over, we have an asset of 500, which is additional asset of 500. So we now come over, we now say here, we have a liability of 800, right? Then we have 500 that we want to use to settle part of that liability. So we use 500 to settle it, and then we now discover that we are going to have 300 left. Are we together? Is it clear now, or is still looking somehow? It's easy, just carry to the other side. So let's now look at all this stuff. So you say how to treat the movement. So we are looking at the theoretical part now. How to treat the movement. So deferred tax liability. Say increase in deferred tax liability would be added to the current tax. Increase in deferred tax liability will be added to the current tax. However, decrease in deferred tax liability would be subtracted from the current tax to get tax expense payable in here. So if it's an increase, let's go back to the table. If it's an increase, look at it now. If it's an increase, last year we had 1,000, but this year we are having only 700. Is it an increase or it has reduced? Who can tell me? Both of them are actually deferred tax liability. So they say increase. If it's an increase from 1,000, it's supposed to increase to either 1,005, 1,006, but this is rather a decrease. So that's what they are saying over here. They say that how to treat the movement. When we are having a deferred tax liability, when you have increase in deferred tax liability, you will have to add the increase to the current tax. Current tax naturally is a liability. Deferred tax also is a liability. So if there is an increase in deferred tax, for instance, last year we are having 1,000 as our deferred tax liability as our balance, then we now discover that it has increased to either 1,500. So increase in deferred tax liability will be added to the current tax because the current tax also is a liability. So we now say, okay, last year it was 1,500. Sorry, last year it was let's say it was 1,000, but this year now it has now gone to 1,700. So you can see that there is an increase. But if there is no increase, then it means there's a decrease. Okay. So can somebody read what we have on this place for me? Somebody read for me. Let's hear. Hello. Okay, so let me take it back to the place. Sorry. So this is where we are. They say that increase in deferred tax liability would be added back to the current tax, while decrease in deferred tax liability would be subtracted from the current tax to get the expense payable. Now, let's look at deferred tax asset. Increase in deferred tax asset would be subtracted from the current tax, while decrease in deferred tax asset would be added to the current tax to get the tax expense payable for the period. Okay, so we are looking at another one. So here we have a deferred tax asset because it's on the debit side, it's an asset, right? So now that is for last year is an asset. However, for the current year, we're also having another deferred tax asset. So now here it was 1,000. Now is now 800. Did it increase or did it reduce? Who can tell me? Did it increase or reduce?
I think it's still reduced.
So it reduced and it's an asset. So let's go back to the asset. They say deferred tax asset increase will be subtracted from the current tax, but decrease will be added to the current tax. So it was formerly 1,000. Now it has decreased to 800. So this decrease now, it decreased by how many? By 200. So what will we do? They say a decrease would be added to it will be added to the current for the period. So since here is a decrease, here we had 1,000 here, and now it has reduced to 800. So decrease in deferred tax asset would be what? Added to current tax. So let's go and check. Even if you are looking at the table, let's go back to the table. To the table now, because it's an asset, right? An asset is always going to be on the debit side. For the last year, it's going to be on the debit side. So we'll come here. For the last year, it's going to be on the debit side. Then for this year also, it's also an asset. Normally, it's supposed to be debited, but we carry it down to the opposite direction. So when we now balance our account, we now say here, we have 1,000 as the highest figure. We put another 1,000 here. So we now say, okay, this place is correct to be 1,000, but here there is what? There is a balancing figure of 200. So since there's a balancing figure of 200, it means this is a liability. So what is it going to be? Our current tax is a liability, and we are having additional liability. So what do we do? We now come here, we now say our current tax is a liability of 800 plus additional liability of 200, and it gave us 1,000. So just look at that way. So the balancing figure now, we tell you whether you are having an asset or you are having a liability. The balancing figure now is on the credit side, and credit side are always liability. Our current tax is a liability also. So since both of them are liability, you add them together. 800 plus 200, you're having 1,000. So let's check another one. I also came to put here elements of the financial statement, asset, like that, so that I can get it. Then that is fine. We've done that before. Let's now go further to another one. Another illustration. We are having a deferred tax liability of 400. We are now having a deferred tax asset of 200. So let's look at it. You're having a deferred tax liability of 400, and now we are now having a deferred tax asset of 200. What has happened? What's happened? Okay. Now, this liability, right? For something to be a liability, it means that it needs to be settled. For something to be an asset, it means that like you have money. So let's look at it. You were owing somebody 400 naira last year, and then this year you have not only become free of the loan, you are having extra 200. So what has happened? What did you do? It means you have 200, the first 400 that you have settled this thing, right? Then you now have additional 200. So that is why we are having this movement. The movement is from the liability, you are moving, there's like a decrease in liability. So let's go and check what they say. If a liability is 400 and it now further reduced to 0 before you now climb and become 200 positive, what has happened? There's a decrease in liability. So let's check. They say if you have a decrease in deferred tax liability, it would be subtracted from the current tax payable for the period. So let's come back to our table. Okay, let's come back to our table. We now have it like this. Where is the place? Is it here? No. Where is it? Yeah, so this is where we are. So if we now come to the table, normally for last year is actually a liability. Just come to your T format, put it as a normal liability. Now for this year is now an asset, right? Because it's an asset, assets are debited. We further carry it down to the opposite side. So it is an asset. Assets are supposed to be debited, therefore carry it down to the opposite side. That's what you're going to do. So when I come here, when I say, okay, this year, sorry, last year it was a liability of 400. Liability are always debited. We debited it. Then we now say this year we're having an asset of 200. So what do you do? Because it's a liability, you are supposed to, an asset, we are having an asset of 200. Now, because it's an asset, assets are always debited naturally. But because it's for the current year, further carry it down to the opposite direction. So we now carry it down to the opposite direction. That is why we have it here. So if you now add this place together, you're having 600. Remember, the balance here must be the same balance here to have a balancing, you're balancing your account. Then that's okay. Inside this space, we have 600, it's fine. What is the balancing figure here? The balancing figure is actually 600. So it means you're having a deferred tax asset of 600. A deferred tax asset of 600. Obviously, it's an asset because if you ever have 400 that if you ever use to clear this one, if you ever clear this loan, right? Then you now add additional 200, which is now positive. So obviously, the total that you had is 600. The first is 400 that you have settled your debt. Then additional 200 is now on top. So you are now having a positive 200 naira. You are no longer a debtor. Last year, you are owing 400. This year, you are having 200 with you. It means that you've not only settled your debt, you are still having an extra 200. It means you had 600 with you, you settled 400, you are left with 200. Does it make sense, everybody? So the total that we have, it means your liability reduced by 600. So that is how we were able to get what we have here. So because it's on, now this is it. This is, last year is a liability. Come and put it normally like a liability, right? It's a balance. It's a balance. Now this year is not a balance. This year is the deferred tax for the year. Last year it was a balance, but this year is a deferred tax for the year. So now you come here, your teeth format, put the deferred tax balance. It's a balance for the year. Now, this year, you are not having 200, which is an asset. Naturally, asset for the year, you are supposed to debit it. But people carry it down to the opposite side. We carry it down to the opposite side. Okay. We now put it here. So that when we add everything here, we're going to have 600. Then you now also have 600 here. Then the difference, the balancing figure that will come here is 600. So this 600 now is an asset. So your current tax naturally is a liability. So you have an asset to actually what? To actually settle part of your debt. So you now say, okay, this 1,000 is my debt. I'm paying 600 out of it to be left with 400. So let's take another scenario, whether another scenario will make sense to us. Now, this scenario now, you are having a deferred tax asset of 300. So you have an asset with you. But this year, you are not, that asset has disappeared. In fact, you are even having a liability. So the asset has disappeared. We are not having a liability. So what do we do? Now they say that a decrease in asset. Let's go and check. A decrease in asset, what would they do? A decrease in asset would be what? Added to the current tax. A decrease in asset will be added to the current tax. So let's come back. Before you are having an asset of 300, it decreased because you are no longer having that asset. It decreased to 0, and then it continued to decrease until it became a liability of 200. So it did not only decrease by 300, it decreased extra by 200, so making it 500 decrease. So let's go to our table in order to be able to understand the treatment. Okay, we come to our table. Okay, I didn't put the table here. Oh, let's try and put the table. So let me come here. I want to copy this stuff. Let me copy this stuff. I hope I'll be able to copy it. Let me see. Copy. Okay. Control C. I copy the Excel there. I come over to this place. And yeah, voila. I want to put it here. Control V. You know work. Oh. You know work. So let's go and insert it. Let's insert a table. By inserting, when you go to your insert, then you want to insert a table. What happening? The insert is not working. So let me do something. I guess it's because, or let me save this in first. I don't know why I need to be saving it all the time. I don't know why. So let me save. Where will I save it? Okay, let me save it here. I want to save it here. So save. So we can't save this file because it's read only. Okay. So I want to save, let me save it extra to this side. Then I want to save it as this. Okay, so we've saved it. So let's try and see whether we can copy that thing now, whether it will work. Let's see whether we can copy this thing now, whether it will work. So we come back here and we want to copy. So Control C. We copy it, we come back over here and we want to paste it here. Control V. Voila, it worked. So what do we have for last year? Quickly, for last year, we are having a deferred tax asset, which is a balancing figure. It's a balance. So we come here on our deferred tax, right? We have a balancing figure of, okay, so let me activate the Excel. Okay, so last year, activate. Okay, so last year, we had a balancing figure that we had last year. We had a balancing figure of, and it's an asset, right? So, undo Control Z. I don't want to copy that place. So let me delete here. I want to delete it. Sorry. Okay, yeah, I want to delete here. So last year, we had a balance, which is an asset. The asset that we had was 300. It's a balancing figure. So we say balance BD. Okay, it's 300. Now this year, what do we have? Who can tell me what we have this year? Kindly let me check. What do we have this year? Okay, you don't have the sheet with you. You don't have the sheets. Okay. So this year we have something else, but I'm coming. I want to do something. Okay. So this year we're having something else. So this year we come over to here. This year we are having a liability. So because it's a liability, please guide me. Because it's a liability naturally is supposed to be what? Or mute your mic. A liability naturally supposed to be what? Or mute your mics now. Do we have accountants on this call? Hello? Can you hear me? Are you scared of making mistake or saying the wrong thing? Okay, because it's a liability naturally is supposed to be put on the credit side. However, what do we do? First of all, carry it down to this place. First of all, carry it down to this place. So we now say deferred tax, defer tax carried down. If you ever carry down to the opposite side, and the answer, the deferred tax, I think it's 200. Is it 200? I think so. So once you carry down to this side, then the next thing you want to do is that, yeah, there's nothing here, but you need to balance your account. So what do? This side has a figure. We now say alt equals, you're trying to solve, you add everything together. Fine. Then here, you now say equal to the balance here, right? That's that. Then the next thing is that, what is the balancing figure going to be? The balancing figure will be equal to this minus the sum of what is in the bracket. So the sum of everything in the bracket here, close the bracket and click on enter. So the balancing figure is actually 500. And this balancing figure is actually on the credit side. So because it's on the credit side, it's saying that we are having a balancing figure, which is a liability. So our current tax is a liability. We're having additional liabilities. That's why it is added. So we now say our current tax was 1,000. We now add 500 to it. It now became 1,500. Are we together? Are we together?
Yes.
So we're done with the movement in deferred tax. And I want to believe that makes sense, right? It makes sense. So let's now look at how to treat current tax. Now, I started by telling you that for the year, you just go and pick your current tax, right? But this current tax also, you may have current tax for last year. So you need to also check the movement. So it means that for you to know what current tax to pick, it has to be the movement in current, for you to know the tax expense that will be put in your P&L, you have to check the movement in your current tax plus the movement in your deferred tax. For your deferred tax, we understand it, there's no issue. But let's go and check movement in our current tax. So that's the next step that we are going to. Okay, so after that, we now go to the next topic, which is going to be cash flow statement against next class. So I believe from here, we're going to end IAS 12 from this class. And I want to believe that we've done a lot justice to the topic. Whoever doesn't understand it now means that the person needs to go and rewatch it. So we've done a lot of justice to it. So let's come here and check here the current tax. Okay, now in your account you have a current tax balance of, in your trial balance, right? You have a current tax of 200. Now your current tax naturally ought to be a liability, right? So since it's your current tax for last year, it has to be a liability, but it's on the debit side, which means that is an asset. It's an asset. So they say that the current tax in the additional information is just a provision. It's an estimate. It is not the actual tax payable. It's just an estimated tax assessment, and as such, it could be an over or under provision, but it would not be known until next year. So now it means that this year now, the taxman, he has actually okay, we have our accounting profit, right? Then we also know that the taxman is not going to accept our accounting profit. He's going to do he's going to work back, okay, to get the current tax. So that current tax, we now pick it. Now, that current tax was done based on certain what would I call it now? It was done based on certain assumptions that, okay, we're taking some factors constant. Like we say, we assume that all those all those all those all the things that we disallowed because we believe that they are not cash items, we disallow them. We say, okay, why you charging why you putting provisions for bad debt, for instance? Why you putting provision for bad debt when the bad debt have not crystallized yet? So it's just an assumption. We just estimated that, okay, since bad debt has not crystallized yet, then you cannot charge that bad debt. So we disallowed a lot of things, and that is how we now got the taxable profit that we use to compute our current tax. So that current tax may change. It's not absolute. It's not the last current tax. So you discover that the current tax that you have in your financial statement, in your note to the in your additional information, okay, is just an estimate. It's not the actual tax that will be paid. Now they say that it's just an estimated tax assessment, and as such, it could be an over or under provision, but it would not be known until next year. Therefore, whatever tax you have in your trial balance could represent an over or under provisions from last year. Now, this is it. Okay, this is it. Last year, right? Last year, when we are this year, let me go back to what we are doing. This year, I told us that the tax expense that you have to recognize on your financial statement is going to be the current tax, right? Plus movements in deferred tax. So we've done the current tax plus the movement in deferred tax, and we now say that, okay, based on this, our estimate, we have to recognize this 1.5. It means that we are no longer taking our original current tax that we have. We have been able to generate another current tax, which we are now going to put in our financial statement, because we are saying the current tax to put is the current tax plus movement in the deferred tax. So this current tax now is what we are going to put in our account for this year. Now, this current tax that we put now, they say it's just an estimate. Next year is when we will know. It's just an estimate. So next year is when you will know whether it is a normal current tax or it's an over or under provisions. So we now come over to this place, and don't forget that okay, let's go on. So that's what they are saying over here. So they said, therefore, whatever tax you have in your, so it means that here, this tax expense that we are trying to talk about is a new current tax that we feel that we are paying in the current year, okay? So it's going to be the movement in our deferred tax plus our current tax. So this current tax that we now have now was just based on some certain assumption. What you will not know until you come to another year. So they say that whatever tax you have in your trial balance could represent an over or under provisions for last year. We now say if the current tax appears on the debit side of the trial balance, okay, if it appears on the debit side of the trial balance, then it means it's an under provision from prior year. Means you still need to pay it. Okay, so now this is it. Okay, now unlike yeah, so we already know that when you have deferred tax on the credit side, it's a liability. When you have deferred tax on the debit side, it is an asset. Also, when you have current tax on the credit side, it is a liability. When you have current tax on the debit side, it's an asset. So it means that there was something remaining that you did not finish paying last year. So you're having an asset from last year, meaning that there's something you did not finish paying. So that is what the explanation for current tax is saying. For deferred tax, it's easy. You just know that you just need to carry this value exactly the way it is. Just carry it in your T account. But for current tax, whenever you have the current tax on the debit side, is an asset. It means that you did not finish paying. An asset was still remaining for last year, which you have not paid for. That's what it means. So we now come here and now say that, okay, if the current tax appears on the debit side of the trial balance, then it means it's an under provision from prior year. Means you still need to pay it. Therefore, when you are trying to determine the tax expense for the year, you need to adjust it with the current tax for this year. In additional information, we have this information. Current tax is 1,000. So this is the trial balance. The trial balance is showing. So we have our current tax to be what? 1,000. Okay, in additional information. Then the trial balance that they gave us. Now, okay, our trial balance that they gave us, we now see that our current tax is showing that from last year, it's showing that we have an asset, which means is an under provision for last year. We need to still pay it. So what do we now do? They say that to calculate the tax to use as current tax, pick the current tax in the trial balance and adjust it with the one in the additional information. Therefore, the tax expense is going to be the net current tax plus the movement in deferred tax. Net current tax plus movement in deferred tax. Net current tax is current tax in additional information plus under provision or minus over provision. So that is it. So I made this easy for you so that if you go through this note, as many times as you go through this note, you are going to understand what is happening. So yeah, they say that the tax expense that you're going to recognize is going to be the net current tax, meaning you check your trial balance you're giving, right? Your trial balance, is your current tax a asset or is it a liability? So if it's an asset, it means that it's an under provision from last year. So it means that if it's an under provision, if it's an asset, right, it's on the debit side, it means you need to add it. You have not finished paying. You need to add it to the current tax that you need to pay for the year. Last year, you under provide, okay, by that amount. So it means that you need to add it to the current tax for the year. But if you have a negative amount, so if you have a credit, that means you overpaid for last year. You overpaid for last year, which means that you need to minus it. Okay, you've overpaid. You need to minus it. So yeah, this year, we now say that in our additional information, we have a current tax of 1,000, right? And then we now have, in our trial balance, we have a current tax on the debit side, okay? Since it's on the debit side, it means we underpaid for last year. But if it was on the credit side, we will say we overpaid for last year. So if you underpaid, obviously you are going to pay. So you now say the current tax for the year, because you underpaid, plus what you did not pay last year, okay? So it's going to be this plus this. However, if you overpaid, your current tax is going to be on the credit side. So you're going to have this minus what is on the credit side, and that is what we're going to have. So therefore, we are going to have this movement. last year we had, no, sorry. Last year we have a balance of 200, and that 200 was actually sitting on the debit side. Now, because it's sitting on the debit side, we say that that is an underpayment. Because you underpaid, you need to pay. You underpaid is an underpayment, you need to pay it. So this year, in our note to the account, we have a current tax of 1,000, and our trial balance, we underpaid. So since you underpaid, you need to pay, add it up and pay it together. So the tax expense now is going to be the net current tax, which is going to be this plus this, then plus the movement in deferred taxes. So that will lead me to giving you an assignment. Are we together? Is it making sense?
Yes, sir.
Okay, it's making sense. So you will thank yourself that you actually attended class with us. So I'm going to give us an assignment. So let me quickly create the assignment for us. Then when I create the assignment, I will share this part of the template that we've walked through so that you can have it, or let me even make it a classwork. We still have from now till 2:30. So let's quickly create a classwork. Okay, if you are not able to finish it, they will not turn it to an assignment. Are we together? Are we together?
Yes, sir.
All right. So I'll make it a classwork. Then if we are not able to finish it, we now turn it to an assignment. So let me quickly create it for us. I love giving you guys assignments because I want to make you people know it. So now if you are preparing your account in the company, if you are an accountant, wherever you are, and then they are telling you what tax are we going to have in our financial statement? What tax are we going to have for the year in our financial statement? You know what to actually do. So you don't need anybody to come and tell you what needs to be done because we've dealt with it extensively. We are not only treating it as for the exam, we're also treating it as though you are going to, what's the word? Use it in real life practice. Okay, so I have this information here, right? Then I want to give us classwork. Okay, so what I'm going to do is this. Number one, define the following terms for me. The first thing, you're going to define, let me now make it bold, Control B, define, it's going to be elaborate actually, define the following terms. Okay, number one, tax base. Tax base. And give me an example. You are going to give me an example of what a tax base is. Define it. What is a tax base? That is number one. You also show it to me. How do we get your tax base? Because it's different there's a difference between you defining it and knowing how to get it. That getting is what I'm after. So define it and also show me an example how to get it. Okay. What is the tax base of an asset? Number two, sorry, let me do something like this. Yeah, I need to put a space here. Right, fine. So number two, what is the tax base? Then number two, carrying amount. Carrying amounts. I'm so loving this our class. Number three, temporary difference. Temporary difference. Number four, we have taxable temporary difference. Deductible. Oh, sorry. Deductible temporary difference. So I feel that this lecture, I can upload it on YouTube. deductible temporary difference. Then, what is the deferred deferred? Okay, double R, deferred tax liability. But the next one, deferred tax assets. Number 4, what other term can you actually define? Is there anything I've not captured? Okay. Show example for each. For each. That is number 1. That is the first stuff. So you can start doing this one now. This is your classwork now. You can start doing this one now. Okay, I believe you should know it. Start doing this one now. Why I now put that is classwork. Then let me now put assignment at the bottom. Number 2, the next one, assignment. Start doing this one now. Then I'm going to collect it by the next one is assignment. Assignment. So you are submitting it. Failure to submit, there'll be a fine. Oh, and you must pay the fine. If you don't pay the fine, you don't enter our class again. I'm coming. Oh, failure to submit, you pay fine. Don't pay fine, you don't enter the class. I'm coming. You can be doing that one first. Why I try to get other stuff. Yeah. So okay. Right. Yeah, I'm listening. What is the question?
Okay, so we are going to do it. Is in our notebook or just a piece of paper or type and send to you?
Yeah, so this is a classwork. So do this one in a book now, your notebook. Then you snap and send to the group. Do you get it? Okay, so let me work on the assignment for us so that we can have the assignment. Let me just copy a question and try and refine it. So from that question, you are going to give me. So let me just copy one of this question and try and refine it. So this question. So I'll copy. I'll come down to this place. I put it here. Okay. Yeah. I come here. I put it down here. Onto V. Okay. So um so from next week we shall start looking at IAS 7, which talks about statement of cash flow. So just like the way we treated IAS 12, and it was very interactive, it's the same approach that we're going to adopt for the other one. So hope to see you guys in class next week. God keeping us. Okay. Okay, so this question is here. There's a question here now. So try and use it. So I just adapted one of the question. ADEX Limited. ADEX Limited. Okay. ADEX Limited. Okay, so that's that. So after you've done with this now you can get your, okay, so here, using the profit and loss approach, get the deferred, okay, get the deferred, okay, get the temporary difference and the deferred tax. So that is that. Then so using the profit and loss approach, so also use the balance sheet approach to get the temporary difference as well as the deferred tax payable. So that's that. Then the next one, let's now look at another question. So this is going to be and then the next question, question 4. Let me try and adapt another question. Let's say in your trial balance now. So let's say that expense tax payable in the profit and loss account. So enter payable in the loss account. So let's have it like this. Deferred tax for for 2024. That's for 2024. So you put the figure that you calculated, okay, in bracket. Put the figure you got from your question 3. question 3. So put the figure you've got from question 3. Then we now have deferred tax. So using this information, using the information below, calculate deferred tax for the current year or 2025. So the information below now use this one now to calculate the deferred tax for the current year. So let me go and check. I want to test your ability. Everything I taught you, I want to test your ability. I want to shake you. I want to move you. Okay, so using this information now, I'm going to use this information to get so this one here. So now expense tax payable in the profit and loss account for 2025 is what we want to calculate. So deferred tax for 2025, put the figure 2024, put the figure you got in your question 3. Then using the information below, calculate the deferred tax for the year. So we now say budget master. Let me say so Bola. Limited has revalued its property and has recognized the increase in the evaluation in its financial statement. The carrying value of the company was, let's say it's 8 million. The carrying value of the company was 8 million, and the valued amount was, let's say, was 10 million. Right. Then they said that the tax base of the property was 6 million. 6 million. In this country, the tax rate payable for profit is this, and the tax rate payable for profit made on sales of property is this. If the valuation took place at the financial year end of 31st December 2024, so 2024, then calculate the deferred tax liability on the property as at this date. No, as at 2025, sorry, as at this date, 2025, okay? So that's what you're going to do. So when you have gotten that we get these two information that you have here, will enable you to get the movement in deferred tax. So you've seen the deferred tax for 2024, okay? The deferred tax for 2024, you are going to pick it from the answer that you got here, okay? But I think it's different names, so different names. Maybe I should change it to Adex Limited. Okay, so let me call this Adex Limited again. So you pick Adex Limited. So now here, so they say that the deferred tax for 2024, you should pick it from the figure, from what you got from here. When you pick that figure, use it as your deferred tax for last year, and then using the information below, get the figure for the deferred tax for this year, so that you can be able to do the movement in deferred tax. Do we understand it? What I'm saying? Do we understand what I'm saying?
Yes, sir.
Okay, so you now use that to get the deferred tax that you need. Okay, so use that together. Then we now go further to now add information about current tax. So let's go to current tax and get some information from there. Current tax. Okay. So remember, in additional information, you're going to have something. Then in your balance, you're going to have something. So calculate the tax to use for current tax. So this is what we have. So now say in the additional information for so and so, the current tax for last year was this, and then the current tax and the okay. Where are we? Where are we? Okay, so in the additional, so yeah, I'm coming. Okay, so that's that. So that's that. As a current tax credit of is it a current tax credit of, let's say, of 5,000. Calculate the tax expense to be shown in 2025 in the profit and loss account, in the shown in the profit and loss account for the year. Full stop. Okay, so that's that. So this is your assignments from here like this, to this side. So you know what to look out for. You know everything that you need to do. Okay, so with this information here, from here, you can always get out your movement in your current tax. Then all these places is going to show you how to get your deferred tax for last year, then deferred tax for this year, so that I can determine the movement in deferred taxes. So your answer from question 3, we let you know the deferred tax for that you carry as your opening balance in 2025. So that is what I did over there. Do we have any question? Are we done with our classwork? Are we done with our classwork? When you're done, let me know. We have 30 minutes more.
Still on it. I think I'm on number 4.
Okay, so since majority of people are not done with it, we might need to take it home as our own work. Okay, so add it to your own work to be submitted by Saturday when we meet. So on that note, we shall call it a day for today. So you can also submit it like if you finish it before the next lecture, you can submit your own work. Yeah, sorry, your class work, but your own work you can leave it till we meet on Saturday. So thank you everybody for your time, and hope to see you in the management accounting class coming up by 2:30. Thank you everybody. Have a lovely time in your class.
Thank you, sir.